So the Fed has a dual mandate. One is unemployment rate and one is inflation. And neither of those mandates suggests, that they should be cutting rates. I'm seeing that we have a growth impulse that's positive now, but we have a very big inflation impulse. This could run away from them if the dollar, really cascades. And so my view has been risk assets are going to keep going.
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance. And joining me this week is Dayan, who's been a regular guest on the show. Expert all things global macro, run a couple global macro hedge funds, has a really fantastic Substack, and always has very insightful research. So, Danny, as always, great to have you on the show.
Felix, thanks for having me back on. What a busy week. I'm sure you're going to be quite busy with recapping all the hangings-ons of this week. So definitely fun time to chat about macro.
100%. It's crazy this week. It's like the amount of data coming out. So obviously this is before a lot of it. We did get the JOLTS report today, but a lot of other stuff coming out in the back half of this week. So lots to get into. But yeah, I just want to start off the top and just get an update on what's your high-level macro framework? How are you thinking about things? We're in this era, it feels like everybody's trying to question Fed independence and what the implications are in terms of what's driving just the overall economy. Is it fiscal dominance? Is that the right way to think about it? Where's your head at?
Yeah, it's quite a volatile start to the year, of course, with the new administration and all of their policy sets. It looks like the first half of the year is a slower growth profile than, what we had the last couple of years. Some of this I think is misunderstood, but let's kind of unpack that. If we actually, there's a lot of noise in the data. It has been the hardest period for me to analyze data. But if we look at Q1, strip out the trade and inventories impacts, it was actually a very strong quarter. It was about 5.8% nominal GDP, excluding those factors. So the headline GDP was, flat, slightly negative, but it actually was a positive quarter. Whereas Q2 will have a nice positive real GDP of maybe like 3%, give or take. But it actually was a substantially weaker quarter. So a lot of people are sitting there and saying, the economy's tipping over. That's it. The Fed is late. And I understand where they're coming from. When you look at the data, you have to analyze, the situation. When I see, this dynamic, I tend to look and say, okay, did something break? Did we have a credit event? Did we have a layoff cycle? We haven't had anything like that. In fact, the tariffs themselves have not even had an actual impact really yet. So by the end of Q2, we were tracking about 100 billion of tariffs collected by the Treasury. Not all of this, is passed through to the consumer, and some of it is sitting in inventories for future sales. So it's not large enough to cause a downshift in the economy. And so, I looked at my framework of financial conditions. We had a huge uncertainty shock. New policy in a big way, rolled out in a chaotic way, not ideal, and very aggressive, on April 2nd. And when we look at the uncertainty, it's rational that you would see some business activity pull back when you don't know what your supply chains are going to look like. Is there an embargo on China? As a consumer, what are we looking at here? My portfolio is down. The market was very, very volatile. Not just down 20%, but we had 6 to 8% days on a number of occasions. The VIX at 60 plus. We had from mid-February till mid-April, a material tightening in financial conditions reflective of that uncertainty. And so it's natural that this has bled through into some weaker, Q2 data. Now, when I look at from mid-April till today, financial conditions have more than unwound that. and they've eased even further. So I look at the impulses from financial conditions, and we're going to get into my new framework there, of course. But I look at it and say, Q3 is looking like it'll be pretty strong. We haven't had a lot of data yet to confirm this, but we had S&P PMIs last week that were pretty strong. The services sector was rebounded very strongly above 55 in the PMIs. If you look at what this implies for real GDP is about 3%, and if you look at what it implies for prices, it's about 4.5%. You would be looking at a very strong July. Just 1 month, just one indicator, but it's consistent with what I'm seeing from financial conditions. And then as we go towards, through the second half of this year, we'll now be able to feel these policies as they start to impact the economy and bite. And there's a demand side, but there's also a supply side. I think the supply side is the bigger story, and I think people are not in tune with this, on the changes to the economy. So we'll have to see how it plays out, but it's going to take time. It's not going to be immediate.
Yeah, when I look at the aggregate of the macro data, and to your point, it's been very difficult to analyze. It's been super noisy, a lot of whipsaws. You really got to dig deep into it. And when I look at most of the data right now that's coming out, like to your point, when you just look at the hard data and the soft data, it was, especially the soft data, was just horrendous in April, and it's just been soaring back ever since. And to your point, we've got started to get some improvements in the soft data, like the PMIs that we got last week. When I look at everything, it looks like this pretty solid rebound is happening. The only exception to that right now, I feel like, is the labor data, and specifically that granular labor data. Because if you compare, you've talked about this already, but if you look at the unemployment rate, it's being affected right now by immigration. So it's quite tight and actually decreasing versus just the previous Fed SAP projections. But we just got the JOLTS report today, pretty weak overall. And it feels like some of that granular data in the labor market is showing some cooling and some softening. What's your read on that versus the reflection of every other part of the economy, which I agree with looks like a pretty solid rebound happening?
Yeah. So again, this is perfect question on the supply versus demand side. We have to take a step back and look at the last couple of years where we were, potential growth for the economy by most economists is around 2%, give or take a little bit. We were growing for 2 years, well above potential at 3% in sort of a steady state of the economy. Normally, you would expect that to get added inflationary pressures to the economy if you're growing above potential. If you grow below potential, you would expect the reverse. But yet, inflation was very sticky, didn't have flare ups, didn't have flare downs. It was just pretty sticky. It tells you that something else was going on, which we didn't know at the time until last August, when it became clear that there was a huge immigration story that was not showing up in the data. And so, what that labor supply from immigration did was it raised potential growth from 2%, long run potential, to 3%. But it was not a permanent change, it's a temporary change where for 2 years we were growing at 3%, which was potential. You come into this year and, Trump campaigned on closing the border, stopping that flow of immigration, and he's done that, very, very well and quickly. The potential growth rate of the economy is now just shot back down to 2%. And you see this, actually, the clearest place you see this is the labor market, where if you go back 2 years ago, the break even level of employment based on population growth was about 200K, and now it's like 70 to 80K. So the demand for labor has slowed as we're at full employment, but at the same time, the supply has slowed even more. If we'll see on Friday what we get in, in the payroll report, but if we're growing above that break-even pace, we are going to have, a lower unemployment rate. The Fed was projecting 4.5 by the end of the year. It's still possible that that happens, but it is also possible that if we print 140 or 120K jobs, in a number of months ahead, that we could even have a below 4% unemployment rate. And so I think the Fed needs to look at this and say, sure, the labor market is not as vibrant as we would like it to be, but if we do stimulate, are we potentially tightening it too much? because it's tightening naturally just due to these immigration, flows going to zero. And, are they okay with 3.8? What is the unemployment rate? What is the goal here? Because at that level, you probably are getting higher wages. So I think we're now have to deal with the capacity of the economy, and we're at that stage of the cycle to understand the capacity of the economy. And, it's been shrunk really rapidly this year. Very unusual to have that in a growing economy. And then, what do we see? Demand, does demand exceed that? And so I think these are really difficult questions for the Fed. But I think my impetus is they could ease and stimulate too much relative to the capacity of the economy, especially if you're comparing to the last couple of years, which are just not normal for the US economy anymore. It's just not the potential that we can really achieve, without stimulus. And so I think they have to be careful about this. And I would love for someone to ask them this, tomorrow. I don't know. I don't know if that'll happen. It tends to be just questions on rate cuts at all times.
Yeah, yeah. It's gonna be questions on rate cuts and how the fight is going with Trump. We already know that, and it's unfortunate because it really, just hits the nail on the head of this situation where this transmission of monetary policy into the economy just feels very convoluted now, and it feels like a lot of people are confused, including the Fed. Like traditionally, it's you lower the Fed funds rate, and that stimulates economic activity, and when you increase it, it slows it down, and that was the tried and true framework for ages. And I think that's a good segue into your financial conditions loop framework that you've developed and iterated on. Because my big question to you, and you can probably solve it through walking us through this, is just what is the real transmission mechanisms that affect the markets and the economy in the modern world that we're in today in 2025? So, would love with that as a jumping off point, just to catch up the viewers on this existing framework that you had originally super quickly, and then would love to just hear of how you've evolved it into this new framework that you just launched this week. Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Before we jump into financial conditions, I'll kind of list three ways, one of which includes financial conditions, of how I look at restrictiveness in simply without any model of the neutral rate, like looking at the economy to tell us the story. So the Fed has a dual mandate. One is unemployment rate and one is inflation. And neither of those mandates suggests, that they should be cutting rates, right? Like neither of them suggest that they're restrictive. If the unemployment rate is below their level of full employment, inflation has been above target 4.5 years. They project it to keep being above target for another 1 to 2 years. That's one way of assessing it. The second way I look at that, the transmission of policy is the typical way that this plays out in a cycle is, when they raise rates, it takes time for that to filter through to the various actors in the economy. But the way it does play out over time is that at some point, interest expense grows as a part of our budget. So household debt service ratios or net interest payments on the business sector, these grow to the point where they eat up so much of our profits or discretionary income that it curtails other activity, whether it's consumption, investment, hiring, whatever it may be. We haven't seen any of this all cycle. I have some charts I shared with you, and we're just not seeing it in this cycle the way you've seen it in other cycles. And it tells me again that policy is not restrictive. And then the last is financial conditions. Financial conditions at a high level are the way that policy transmits to the economy via the markets, and that large moves in the markets impact the economy in a sort of reflexive manner when you're in a steady state. If you don't have a big overarching credit event or layoff cycle, then as financial conditions change in a big way, it'll reflexively impact the economy. And my framework for the last couple of years was what I called the FCI loop. And it was a very straightforward dynamic because we really didn't have credit as a driver of the economy the way it has been in most cycles. The U.S. is a credit-driven economy, and we haven't had the ups and downs of credit as you would see over a cycle. And so, what was really driving the economy for the last couple of years was income growth and the wealth effect. Household wealth is up to something like 650% of GDP. It was in the 1970s, as an example, 350% of GDP. So the economy is much more sensitive to this than it used to be. And so, what we would have over the course of the last couple of years is we would get overly pessimistic situation. We need rate cuts, et cetera. The bond market was rallying and pricing a lot of rate cuts. The dollar would weaken. These are both loosening financial conditions. And then at some point, the equity market would like this and it would rally. That also loosens financial conditions. So we would get like a broad based loosening. And then that would lead to a predictable pattern, for me at least, that 2, 3 months forward, we would get better economic data due to this loosening. The equity side of things would improve household wealth. That leads to a better consumption profile. The dollar weakening, it helps equity foreign revenues. About 30% of revenues are foreign. Those get flattered when the dollar weakens. It improves import prices, things of that nature, as well as liquidity in the system. And the 10-year would tend to see an impact on housing, not like a robust housing market, but an incrementally better situation than what we had before. You'd see a pickup in mortgage applications and home sales would, have a couple months of better data at that point. But once we would get the better data, we would get a financial conditions broad-based tightening. So rates would start to move back up. At some point, they would move up enough where the dollar would strengthen, and equities at some point would take that badly. Typically above 4.5% on the 10-year. And so then we would go through these like mini little cycles of every 3 months. And it's fairly predictable. That's why I called it the loop, is that it was almost self reinforced, or self correcting, I should say, is a better way of saying it. Coming into this year with these policies from the Trump administration, the dynamics have changed. And I recognize this around Liberation Day, that we now have policies that, instead of a broad-based tightening, which brings down growth and also brings down inflation, or a broad-based loosening, which does the opposite, we now have policies that could be growth negative but inflation positive. Or we could have the opposite. We don't know, but the correlations between markets have changed. The dollar and the 10-year are not necessarily moving in the same direction anymore. We're seeing the front end of the curve and the back end of the curve moving in opposite directions in many days. We're seeing obviously equities and the other aspects as well. And so what I did was created models to actually separate the growth impulses from the inflation impulses that we're getting from financial conditions, from these different financial condition dynamics. And so we had to break out the individual asset classes and decompose how each one is impacting these various growth and inflation dynamics, and seeing that not only those impulses, but over time, when they hit and how they impact. Because you could have, most people are just very simply looking at the financial conditions index, whether it's the Goldman index, the Bloomberg index, whatever. But now that we could have these dynamics moving in opposite directions, those indices won't tell the real story. And as well, the growth and inflation dynamics are different. So now I'm able to track both on a backwards basis what these dynamics are, where that leaves us as of, let's just say, as of the end of Q2. But then I'm also able to track in real time, like week by week, how these impulses are evolving. And, to me, I'm seeing that we have a growth impulse that's positive now, but we have a very big inflation impulse, bigger than what we've had for the last few years. And there were other surprising findings as well when looking at the individual asset classes, things that I was not expecting. And so now this model is just very dynamic in being able to, in real time, assess, how this will impact the economy, and then adjusting my asset class exposure based on that, in a way that we didn't have before. And I don't think anyone's ever done this. So I'm really proud of the work, that me and, my analysts were able to do at all. My analysts, we were able to.
Yeah, amazing. It's some really fantastic work. So would love to just get a bit more tangible on some of the results that you're seeing from it. So you already mentioned there that you're seeing a pretty positive growth impulse and a very positive inflation impulse. Would love to just hear a bit more tangibly about some examples related to that. Because the first thing I think about is, okay, tariffs. So that's a short-term price level increase, but maybe negative growth medium term. Okay, immigration, cutting it, like land border crossings are at zero now. What does that do? Okay, that's probably negative for growth, but positive for wage growth on the medium term, something like that. So I can see how there's these like short-term impacts and medium term impacts. So I'd love if you could just mechanically walk through some of these examples of these policies and how they're being reflected in the model.
Let's go asset class by asset class, because I think the results are a bit surprising in some cases. The most straightforward, asset class is equities, where if they go up, substantially, the Nasdaq's up 40+% since the low. Obviously, some of that was recovery from the low, but now they're up, call it 10%, on the year. The S&P and Nasdaq are up on the year. That has increased household wealth. Household wealth increases, it tends to have a positive impact on consumption, as you just feel wealthier. If your household net worth has gone up by 10% in a short period of time, these are moves that usually took years to generate, 10% wealth. But if you're generating that in 2, 3 months, naturally you feel a little bit more comfortable on going out to dinner, going out to restaurants, taking a vacation, whatever sort of, discretionary consumption that you want to do. What I found very surprising, and I was not expecting this, is that equities directly through the wealth effect have had a positive impulse on inflation since 2024. So they had a negative impulse, obviously from the tightening in 22, and that carried forward over 23. But by 24, we started to see that. And so, for the Fed, when they say we don't look at the equity market, they might be making a mistake in not looking at the equity market in some ways, like the 99 2000 episode, when risk assets are doing what they're doing and flying, and speculation is, starting to pick up in riskier parts of the markets. They need to pay attention, because it can actually be proven that it has a positive impulse on inflation. That was surprising to me. Now, the other aspect is, the dollar. So why is the dollar, weakening as much as it has been? It's interesting because if you look at, for example, the front end of the curve is what typically dictates the dollar, not the 10-year, not the 30-year. And when you look at the front end, we have priced 75 bips more of cuts by the end of 2026 than we had in February, in spite of the CPI swap market pricing a higher inflation profile. Okay, so you look at something like, 2-year, 1-year, you can break it out to OIS rates, which is like the equivalent of Fed funds. That has moved sharply lower, while we're, increasing the inflation swap, expectation. And that effectively implies a negative real rate, or a downward move on real rates, which is typically very negative for the dollar. Now, the dollar, when it weakens, tends to be, positive for the equity market. But as I said, 30% of revenues come from abroad. That translates, much better when you have a 10% weakening in the dollar. And it improves liquidity in the system, the supply of dollars to not just US, but around the world. And then last but not least is it raises directly import prices, right? So the US is an import driven economy, buying things from abroad. That means, the dollar being weaker, things cost more. Things were just going to cost more. And as a result, it has a positive impulse to inflation. Now, when we originally were looking at trade wars, we were assuming that the dollar would strengthen to offset the impact from tariffs. But we're seeing the opposite. And so it's adding to it. And so, I have a chart that I brought with you that shows the impulse from the dollar to inflation just spiked in Q1. We don't have Q2 data yet because we'll get the GDP report tomorrow and we can update it. But even since Q3, we're seeing until the last 2 days, the dollar selling off, and you see a big impulse to inflation from the dollar. The 10-year was actually the most complicated. And in the 10-year, it actually depends on what's driving the 10-year higher. So this was very surprising to me. In my prior loop framework, it was 10-year up. That's a tightening. Turns out it's not that simple. The 10-year can go up for one of three reasons. It can go up because real rates are going up, growth is improving. Well, then 10-year goes up, but so do equities, and you actually don't get a tightening. This is actually the 10-year is just reflecting better growth profile at this point. It's not imposing a tightening. You can get the 10-year going up because inflation expectations are going up. That is a different impact. That has an impact that's positive on inflation and negative on growth. So here you have mixed reactions from the 10-year moving up. And that's what we've seen for the most part this year. And then the last one is the term premium. The risk premium for holding bonds goes up for whatever reason, because their deficits are too high or whatnot. Then you have a situation where it imposes downward pressure on both growth and inflation. So when we decompose all of this, it's really interesting because the 10-year is higher than where we have been the last couple of years on average, but it's actually a neutral impulse for the most part due to the differences between inflation expectations going up and the term premium going up. They're kind of offsetting each other. The equity side is quite straightforward, but it's the dollar that is having this huge, huge, huge impulse on not just growth, but inflation. And so I think, that's where the Fed should really be. They haven't talked about the dollar at all. And I think they need to be talking about the dollar. It actually goes into, the doom loop, thesis that I brought on your show last time, where this could run away from them if the dollar, really cascades on it. And that's where I think if they cut inappropriately when the economy doesn't need it because they just think neutral is lower or whatever, the dollar would be the big reaction function, and that would raise inflation, really aggressively on a going forward basis. So really just fascinating to be able to have all these different impulses and impacts, and then aggregate them together to look at the overall economy. But it just gives me a substantial edge relative to my prior framework in knowing how to position myself, for the immediate future,
Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHX Felix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. That's fascinating. So I want to take that and contrast it with a couple what I feel like are common frameworks in the world these days. So one of them is that when the fiscal authorities run a fiscal deficit as a percentage of GDP at 7%, which is basically what we historically used to do in recessions, now we're doing that at maximum employment. Of course, that leads to, higher interest income for those that own T-bills and money market funds. And then, those people take that money and they go spend it. So therefore, a higher fiscal deficit will lead to actually a hotter economy. So by having high rates, we're actually seeing a heating up of the economy. That's one existing narrative out there, probably mostly closely aligned with the MMT crowd. Another one is what we talked about earlier, which is this traditional notion that, okay, you lower the Fed funds rate, the cost of borrowing is lower for people, so they can borrow more cheaply. Therefore, they will borrow more and then spend more, et cetera, et cetera. Their liabilities are less expensive. And so that's sort of been the existing framework. But I would love to just contrast with what you just articulated, just those two things, because it feels like there's parts of them that are relevant to this loop, but not entirely. So, for example, you mentioned how the lowering of rates, you specifically mentioned the impact on the currency and less so just on the borrowing abilities of the individual. So I'm curious, is the right way to think about, changes in Fed funds rate more so to do with the impact on rate differentials and therefore currency, and less so on just like the credit ability of the economy? Is that the way to think about it? And in the same vein, like, what's the right way to think about that fiscal deficit thing as well?
I'll start with the fiscal deficit because I get this comment a lot, and I think it's a misconception, and I think MMT, frankly, is a bogus theory. But every hiking cycle, interest income goes up, right? Like it always goes up. Whatever you put into savings at a higher rate, you earn more than you did before they hiked rates, right? So the that is not unusual. It typically goes up 20 to 30%, and we're up 25% on interest income relative to before the cycle. Nothing unusual has happened there. The difference is you typically also see a rise in the debt service ratio, in the net interest payments, the things we talked about earlier, where that curtails activity and that has a bigger compounding effect in the rest of the economy. And so the short answer is they just simply didn't hike enough, given the fact that households have locked in borrowing at very low levels in the housing market, given the fact that corporates did the same. They didn't hike enough for the negatives of hikes to outweigh the benefits of hikes. And this is part of the issue. Now, if I really were to go down the MMT route, you would see that savings rates would go up substantially if interest income was so stimulative, right? So if interest income outweighed other opportunities I have to do with my money, then I would put all my money in the money market if rates are that attractive. I wouldn't be investing in the equity market. I wouldn't be investing in other areas. And then you would see savings rates really rise. You're not seeing that. Savings rates are, lower than where they were last cycle in spite of materially higher rates. And I think that's a demographic story, which I've talked about many times. So I really think that the MMT story is a convenient one. It's only there because they did not hike enough to break the economy. Look, we saw this in 99, 2000. In 98, we had the Asian financial crisis. They cut two or three times, I don't remember, but they cut rates when they had a very low unemployment rate. Financial conditions went overdrive, and they ended up having a hike to 6.5%. They reversed the cuts and went further, another 150 to 6.5%, and until it broke everything. It broke, the dynamics of debt servicing. It broke, equity markets. It broke all these things, and so they didn't do that because they didn't want to break the economy. They wanted the soft landing. That was their objective. So they just never went high enough to actually inflict the pain side of rate hikes. And some of it is just the unusual nature of what balance sheets were like because of 2020 and 2021 and the 10 years prior, repairing balance sheets after the GFC. We're both Canadian. Canadians did not repair their balance sheets. As such, they were more vulnerable to rate hikes. You've seen activity slow as a result of rate hikes. You've seen savings rates go up quite a bit. You've seen unemployment rate go up quite a bit. And you've seen a worse outcome in housing than you have in the US, where you've had price declines, where you haven't had that in the US. It's still growing in price terms. So that tells you, and the Canadian and the US economies are very similar. So, there's really no reason it should be different other than the balance sheets were just different. And so that clearly illustrates it, there. And Canada and the US hiked to very similar levels within 50 bips of each other. Given the household balance sheets, you would expect the US had to hike 150 higher than Canada did to get the same, tightening. On the other side of things, you're right in that there's, the front end cuts, they help only floating rate borrowers, which is like some small businesses that access lines of credit, from banks and things of that nature. So for small businesses, they do want rate cuts. But what matters for the corporate sector, they borrow in the capital markets. What matters for the housing market is going to be the tenure. So this takes us back to, cutting when you need to versus cutting based on some theoretical framework that tells you you are restrictive, we need to cut. And I find that framework has not worked all cycles. So the fact that they still apply it is shocking. I think we can go back to September. We had a concern over the labor market. Turned out it wasn't, and I was on it saying it was immigration for the most part, but it wasn't as bad as feared. And has that improved housing? It hasn't, because the tenure is substantially higher than where it was when they first did those cuts. Now, maybe some of it, the tenure was too low due to the freak out, but still, we have not seen the tenure come down this year. It's really been in a range. It's frustrating me. I think it should be higher, but it's been in a range. And you're not seeing the credit sensitive parts of the economy respond. So the way that the rate cuts in a voluntary rate cuts have impacted the economy is through financial conditions. And we look at Z6, SOFR Z6, December 26 at 3.25. Markets are very, 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 very happy, very enthusiastic, and have been growing rallying very strongly. Obviously, the dollar has taken this negatively, and even though we have that to me is as big a sign as any that 3.25 is telling you it's stimulating these parts of the markets, that neutral is higher than that. Maybe it's not as high as I think it is, but that remains to be seen. And so I think there's different ways that rates are going to impact the economy, which is why I love my financial conditions framework, because it really is going to break it down as we get these movements, these incremental movements. Really does able for me to pinpoint. Let's just say we rally if QRA tomorrow with Bessent, and he does the ridiculous thing of going 100% to bills. Obviously, the long end will rally pretty strongly. And if that happens, then I'll be able to pinpoint and see, okay, we expect housing to improve, on a going forward basis, and we'll be able to see that from financial conditions. So yeah, I mean, it's not the U.S. is a very large economy with many different impacts, and when we look in aggregate, it maybe isn't always as straightforward to people. But I'm happy I'm a little able to squash that MMT nonsense a little bit.
Yeah, 100%. All right. So with that established, I would love to hear about your outlook on the dollar, because I feel like that is incredibly important right now. And there's a few different levers I see. So there's obviously the Fed meeting this week, where there's no expectations of cuts, but potentially some guidance towards cutting in September, or perhaps they'll wait out until Jackson Hole in August and then indicate for a cut in September. So that feels like a potential outcome. And then, of course, there's the tail risk of what will happen when Jerome Powell is done as the Fed chair and who will come in next. And you can see the SOFR curve starting to speculate on that as well, which will have some meaningful impacts on the dollar. And then the third variable is just around the balance of payments dynamics of tariffs, et cetera, and that the doom loop scenario they mentioned earlier, they talked about last time on the show. So Yeah, with all three of those variables and any other variables that you think are relevant, would love to just hear where's your head at with the dollar.
The first is, we're as a market pricing cuts that based on the mandates, based on financial conditions, based on equity markets, things of that nature, that we don't need. And so when you have added rate cuts being priced in response to a higher inflation profile, that is just not making people want to hold the dollar. And so, I view that as long as they're in this sort of obsession with dovishness, look, if you're data dependent and you have full employment and you have inflation above target, you should be neutral, which they're trying to say they are neutral, but you're not really neutral if every speech and every conversation you have is about when and how much to cut. And it's that's not neutral, right? Like, that's I have a predisposed bias to cut, and I'm just waiting for it to happen. And what happens is the markets price those cuts ahead of time because they expect you to do that, and they know your reaction function, and as a result that makes the dollar unappealing in response to a higher inflation profile. So that's number one. Number two is what you highlighted is, we all know and can see that, Trump is going to appoint a super dove to the Fed next year. Now, I don't know if, it'll be Waller, Bessent, Hassett, or Warsh, but all four of them are dovish. And some of them are very extreme loyalists to Trump to the point where they may do what he wants, even if it's not appropriate to the economy. We don't know yet how the rest of the committee will respond to that. But we do know that that's the direction of travel. And it's a big reason why 2025 pricing has come closer. It's actually, I think, a little bit less than two cuts at this point, but 2026 is, remained with a substantial amount of cuts. And for this reason, I wouldn't fade 2026, even though I think it's too rich. I wouldn't fade it because we know that that's coming. And, that makes the dollar unappealing, from that standpoint. A tax on the independence of the Fed and, appointing someone who will just do the president's, bidding, that is the same story. It raises inflation, it makes the dollar unappealing. And then the last is, when you impose trade barriers, it's to reduce trade flows. And if you reduce trade flows, this is the last question you had. If you reduce trade flows, you also reduce the amount of dollars that are supplied to your trading partners. And if you reduce the amount of dollars that are supplied to your trading partners, they have fewer U.S. assets to buy on a going forward basis. In April, we were worried about like capital flight. Hasn't happened, in a big way, but other than like that week. But what we have seen is no buying. We're not seeing buying of U.S. securities, over the 3-4 month, period in aggregate. We're not seeing buying. So what we are seeing is foreigners say, I want to hold my assets, but I'm going to hedge them. And so we're seeing a lot of hedging of that, but we're not seeing going forward buying. I think that's notable. And if the economy does start to weaken, then you'll see them actually say, I need to sell my equities, right? And then you'll see another pressure on the dollar. So I'm in the, multi-year dollar bear camp. Where I think the interesting aspect of this is, I don't think that because these things happen with lags, I don't think either the Fed or the White House understands that this is adding to inflation pressures in the forward space. And I don't think that they understand that at some point this could really go on them in a way that constrains them from what they want to do. And the biggest, Trump's approval rating on inflation has collapsed to Biden levels, and it's just kind of surprising to me, given that he's spent as much time as he has on trade when it's clearly going to raise prices, and this is the biggest thing that people hate. and are angry about is this, and, maybe that other story that's come out in the last few weeks. But the we don't need to go there. But the inflation side, I don't think they've recognized that the dollar is a constraint on them. And when I talked about the doom loop, it was, this same dynamic in 1979, where the economy was weakening, but you had inflation coming back again. Was way too high, and they didn't want to deal with it because the economy was weak. And they thought, the Fed always likes this: if growth is weak, inflation will be weak. It doesn't always work out that way, and so inflation was very elevated, even though you had a rising unemployment rate. They wanted to cut rates because of the unemployment rate, right? But the dollar, anytime that they would get, think about that, the dollar would weaken further. And anything that they did, everything that they tried to do to stabilize the dollar, other than hiking rates, just led to the dollar continuing to sell off. And it reached a point where Volcker recognized the only way we can stop this inflation is by hiking rates and getting the dollar to strengthen. And, similar to having the financial conditions tightening, they will need that to solve the inflation. And if this dollar keeps weakening the way it has, this will be a constraint on the new Fed, the new Fed that we get next year. That's why I call it a doom loop. Is everything they want to do involves lower rates and involves a weaker dollar. But be careful what you wish for, because that'll raise inflation. And the chart that I shared with you, you'll see it's a very sharp impulse to inflation from the dollar, and it could get worse.
I want to round out this conversation by talking about how to take these frameworks that you have and actually execute on them, either through portfolio allocation or trade. Because when I hear you talk about a dead doom, or like a doom loop scenario with the US dollar, I would assume that you've been shorting this whole rally in equities, but you haven't. You've actually been quite bullish on equities, for example. So I think that's an important distinction, and I would love for you to just unpack how do you incorporate and consider these dynamics that are very real and tangible, but also will take a while to play out. And for example, during Liberation Day, we saw those correlations that were evident of capital outflow, but since then it's sort of chilled out. So you wouldn't quite see that same mechanic degrossing of U.S. assets. So obviously, like, shorting equity has been losing trade. So yeah, we'd love to just hear and have you round out how you take these frameworks and how you think about actual execution in markets, so that you don't just get steamrolled outright shorting equities with your whole book or something because of this scenario, for example.
Yeah, I mean, the equity market started to recover over this taco narrative. Trump always chickens out. It turns out it really wasn't that at all. It really was, we went too hard too fast. We need to buy time for businesses to adapt. We need to buy time for supply chains, people to figure out their supply chains. We need to buy time for the markets to get comfortable with this policy. And so Trump, he executed that well. Besant, Moran, these guys understand markets. They clearly were in his ear and saying, the markets are your constraint right now. You need to slow your roll. But we're at other than China, which is lower than the, embargo levels, we're at very similar tariff rates. And so the policy really didn't change. It just was delayed, and he took time. And now he's secured the deals he wants, and we'll see how it all plays out. But the first bit of inflation popping a little bit higher is not troublesome for risk assets, because it raises revenues. And so you have two impulses to revenues coming from this. One is you have the some inflation. It really is 3 to 4% inflation doesn't usually doesn't get taken badly by the equity market. 4+% inflation tends to get taken bad by the equity market. So when you look at inflation, the question is the Fed going to tackle it? If the Fed is not going to tackle it, then inflation is not necessarily a bad thing at these levels to the equity market. So that's first thing. Secondly, then the dollar weakening is adding another bit of impulse, to corporate revenues as well. And so both of these are, helpful. And then I look at inflation profile. Everything I see in my framework tells me it's going up, not just via tariffs, via, money supply, via financial conditions. I see services companies saying services PMIs, prices paid. They have nothing to do with tariffs. They're taking advantage of this. And yet I don't see the bond market. This has been my frustration is I expected the bond market to break. I don't see the bond market taking this very seriously. And so if the bond market doesn't take it seriously, where do you feel the negatives? You don't. And so my view has been risk assets are going to keep going until the bond market or the Fed gets serious about inflation. If I saw us, shooting up towards 5%, I would not be long risk assets. Um, and so that's one way of looking at it. The other way is actually using my financial conditions framework, where if I see inflation profile going up, but the growth profile going negative, that informs me not to be long risk assets. That informs me I should be just bearish bonds. I probably don't even know what I would want to do in FX. Just bearish bonds, maybe long commodities, but that's it. On the flip side, if we get a situation where my growth impulses are improving and inflation impulses are not going up, they're just staying static or even going down a bit, that would be Goldilocks. That would say go max, on risk assets. Don't have anything to do with fixed income. I don't know what the dollar would do in this case. And so, to me, it would be I take the cues from these. Now, if you have growth up and inflation up, you would expect to see the old loop dynamic where we get broad-based tightening, where equities go up, bond yields go up, and the dollar goes up. At some point, that would hit equities, but it hasn't yet. The dollar has continued to be soft, other than the last 2 days, and yields have not gone up. They've just been in a range, and so that's kept equities in a comfortable position for the most part. And then, last but not least, the psychology with equities has been really fascinating to me, where the retail community is just very exuberant, but the institutional community has been doubting this rally every step of the way. And so positioning has been very, very slow to catch up. It is catching up now. We're getting closer to full positioning. We're seeing chasing. We've seen hedge funds have to cover shorts that they didn't want to cover. The unprofitable tech companies, the small caps, these guys, which may be the sign that we're peaking out here. We'll see how it plays out over the rest of this week. But that's how my framework actually gives me that flexibility to see what impulses am I looking at, and obviously adding the fundamental: are the policymakers going to respond to this, right? And so far, the Fed, they've never once said what they would do if inflation will be persistent. They say if it's transitory, then we'll resume cuts. If it's not transitory, or inflation expectations are unanchored, and so on and so forth, they've never really said what they would do. And so equities take their cue from that, and that, hey, it's a party. They're not going to take the party. If anything, we'll be fine as is. Policy is stimulative here, but they may actually make it even more stimulative. Great. So we see that in everywhere. We see it in crypto, which has had a very good run. We see it in risk assets. I take my cues from all of these messages.
Amazing. Well, look, Danny, that was a really great walkthrough. Enjoyed that a lot. Where can folks go if they want to check out this framework that you've developed?
Yeah, so the link to Macro Musings is at my Twitter profile, Dayan5. You can check out that. It's the link for it's dannydayan.substack.com if you want to check it out, directly there. I write weekly notes that summarize the prior week, as well as preview the coming week, and then I write these deep thematic pieces like this financial conditions note. Some other notes that I've written recently that I think are really interesting as well, on money creation or Japan's trilemma, very, very, all the things that I find interesting that hopefully people find interesting as well. So come check it out. We also have a chat room where, we're able to look at the markets in real time and kind of assess what's going on. And I inform everyone all the trades I'm doing and things of that nature. So yeah, it's been a fun journey to build this, and feel free to for anyone listening to who wants to learn more to check out those links and check it out and come join us.
Cool. All right. Well, thanks for joining again, Danny. Really enjoyed that.
Thanks, and have a good one. And let's see how the Fed meeting is tomorrow.